Imagine you are a detective. You arrive at a scene and you need to identify which footprints matter and which ones are just noise. You could mark every single footprint on the ground, but that would give you hundreds of data points and no clarity. Or you could identify the significant footprints, the ones that tell you where someone actually walked, where they stopped, and where they turned around. That is exactly what identifying swing highs and swing lows is. You are not marking every candle that reversed. You are identifying the significant turning points that tell you the real story of the market. And getting this wrong is one of the most common and most invisible mistakes in all of retail trading. Because you cannot read market structure without first identifying the right swing points. And if your swing points are wrong, everything built on them is wrong too. They look at a chart and they see dozens of potential swing points. Every small reversal looks like it could be a swing high or swing low, and when everything looks like a swing point, nothing is a swing point. Because significance requires contrast, a swing high is only meaningful if it is clearly higher than the candles around it. A swing low is only meaningful if it is clearly lower. And the question of how to determine what is significant enough versus what is just market noise is exactly what this video answers. The mechanical definition of a swing high. A swing high is a candle whose high is higher than the high of the candles immediately to its left and immediately to its right. That is the basic definition. But the basic definition is not enough for practical trading, because in that definition, almost every candle in a choppy market qualifies as a swing high. What we need is a qualified swing high. A swing high that is significant enough to be a real structural turning point. The way to qualify a swing high is by the number of candles on each side that have a lower high. The more candles on each side with a lower high, the more significant the swing high. A swing high with one candle on each side is barely a swing at all. It is likely just noise within a range. A swing high with 3 candles on each side with lower highs is starting to mean something. A swing high with 5 or more candles on each side is a significant structural turning point. It means price went up to that level, held there while multiple time periods passed without price exceeding it, and then reversed lower. That kind of swing high represents a real decision point where sellers were in control for an extended period. Here is an analogy that makes this concrete. Think about watermarks on a cliff face. Every small wave leaves a mark. But those small marks are not meaningful. The meaningful mark is the one left by the highest wave before the tide turned. The one that required the most sustained effort to reach and the most sustained resistance to stop at. That is a significant swing high. The one that tells you something real happened there. Not every ripple. The tide mark. The mechanical definition of a swing low. A swing low follows the same logic in reverse. A candle, whose low is lower than the lows of the candles immediately to its left and immediately to its right, qualified by the number of candles on each side with a higher low. More candles on each side with a higher low means more significant swing low. A swing low with 5 or more candles on each side telling you price reached that level, held while multiple periods passed without going lower and then reversed higher. That is a real structural turning point. Buyers were present at that level with enough conviction to hold price above it for an extended period before it moved higher. The analogy here is a valley between 2 mountains. A puddle in a parking lot is a low point, but it is not meaningful. It is just the result of rain filling the nearest depression. The valley between 2 significant peaks is a meaningful low point. It represents the place where the terrain stopped descending and began ascending again. Structural significance requires context, not just the lowest point you can find. The lowest point that represents a real change in directional momentum. The 3 levels of swing point significance. Not all swing points are equal, and treating them as equal is a mistake that leads to cluttered analysis and bad trades. There are 3 levels of swing point significance that every trader needs to understand. The first level is the minor swing point, 3 or fewer candles on each side. These are the internal structure swing points we discussed in video 7. They matter for entry timing and short-term analysis on the lower time frames, but they are not significant enough to anchor your directional analysis on the higher time frames. A trader who uses minor swing points to determine the overall market structure on the daily chart will constantly be confused because minor swings form and break every few hours. The second level is the intermediate swing point, 3 to 5 candles on each side. These are the swing points most traders use for 4-hour and daily structure analysis. They are significant enough to represent real turning points in the market. When an intermediate swing high holds for 3 to 5 candles on each side, it means the market genuinely paused and reversed at that level. These are the swing points you use to define bullish structure, bearish structure, break of structure, and change of character on your primary analysis time frame. The third level is the major swing point, 5 or more candles on each side. These are the swing points that anchor the highest time frame analysis. They represent the most significant turning points in a market over weeks or months. On the daily chart, a major swing high with 10 candles on each side represents a level where price was rejected for 10 full days before reversing. That is not noise. That is institutional decision-making happening in real time. Major swing points on the daily and weekly chart are the levels where the most significant liquidity pools sit. They are the levels most likely to be targeted by sweeps, and they are the levels most likely to hold when retested. How to identify swing points in practice? Here is the practical process for identifying swing highs and swing lows correctly in real time. Step 1 is to choose your analysis time frame. If you are doing daily analysis, you need daily swing points. If you are looking at the 4-hour chart for setups, you need 4-hour swing points. The time frame determines which level of swing significance you are looking for. Step 2 is to scan from left to right chronologically. You are not looking for patterns. You are looking for turning points, moments where price changed direction, and that direction held for multiple candles before the next turn. Step 3 is to apply the minimum candle rule. For intermediate swing points on the 4-hour chart, require at least 2 candles on each side with a lower high or higher low. For daily swing points, require at least 3. Step 4 is to verify with price action context. A swing high is more significant if it formed after a strong upward move. A swing low is more significant if it formed after a strong downward move. A reversal at a level after a sustained move in one direction is more meaningful than a reversal in the middle of a choppy range. The most common swing point mistakes. The first mistake is marking too many swing points. This is the most common mistake, and it creates what I call structural fog. When you have 20 swing points on a 4-hour chart that spans 2 weeks of trading, the chart becomes unreadable. You cannot determine structure because every minor fluctuation is labeled as a significant swing. The rule is ruthless simplification. If you look at your chart and you see more than 5 or 6 swing points on a screen's worth of data on the daily chart, you are marking too many. Remove the ones with fewer candles on each side and keep only the most significant. The second mistake is using swing points from the wrong time frame for your analysis. Using 1-hour swing points to determine daily structure is like using a ruler to measure the distance between cities. The tool is wrong for the job. Daily structure requires daily swing points. 4-hour setups require 4-hour swing points. 1-hour entries require 1-hour swing points. Match your swing point time frame to your analysis purpose. The third mistake is treating all swing highs equally. A swing high that formed after a 300 pip move and held for 8 candles on each side is fundamentally more significant than a swing high that formed after a 50 pip move and held for 2 candles on each side. They are both swing highs in the technical definition, but they carry completely different weight. When price returns to the major swing high, the reaction will be much more powerful than when it returns to the minor one. Weighting your swing points by significance, not just by definition, is what separates institutional-level structural analysis from retail-level structural analysis. Reading the story, swing points tell. Here's where it gets truly interesting. Once you can identify swing points correctly, they do not just define structure. They tell you a story. A bullish trend with swing highs and swing lows that are getting progressively further apart in terms of price range tells you momentum is building. Each new high is made with more force than the last. Each new low holds higher than it had to. The buyers are getting stronger with each swing. A bullish trend where the swing highs are getting harder to make, where the highs are barely above the previous high, and where the swing lows are barely holding above the previous low, tells you a different story. Momentum is weakening. The buyers are having to work harder for each new high, and they are barely maintaining the lows. That trend is approaching exhaustion. It may not reverse immediately, but the warning is written in the progressively weakening swing points. This is something no indicator can tell you, because indicators are derivatives of price. They are calculations applied after the fact. But swing points are primary. They are the direct evidence of where buyers and sellers made their decisions. And the quality of those decisions, visible in the size and spacing of swing points, tells you the health of the trend in real time, connecting swing points to everything that follows. Every concept from this point in the series connects back to swing points. Liquidity pools sit at obvious swing highs and swing lows. That is where the stop losses are. Order blocks form at the candle right before a swing point is created. That is where the institutional buying or selling originated. Fair value gaps appear within the moves between swing points. Volume analysis confirms whether the swing point was formed with genuine participation. And market structure, which we covered last video, is simply the sequence of qualified swing points telling you who is in control. When you get swing point identification right, everything else falls into place. When you get it wrong, every concept built on it becomes unreliable. The swing point is the atom. Everything in this series is built from it. Here is the mindset shift from this video. Stop looking at your chart and thinking about trades. Start looking at it and mapping turning points. Before you consider a single entry, mark the significant swing highs and swing lows. Connect them. Read the story they tell. Is momentum building or weakening? Are the swing points getting larger or smaller? Is the most recent swing point a break of structure or a change of character? Those questions, answered from correctly identified swing points, give you a reading of the market that is more accurate than any indicator combination you will ever apply, because you are reading the market in its own language, not through the distorted lens of a derived calculation. Drop a comment. After watching this video, go to your chart and tell me how many swing points you had marked before and how many you have now after applying these rules. I read every single one. See you in the next video. Stay disciplined.